Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now this time around, it's tested it a number of times and it breaks right through it. So now that support zone becomes a resistance zone as it retests it. So now it's going to be support because it's underneath the current price action in this chart. So very basic concept here of understanding support and resistance levels. This chart down here is one that I used in a previous class. And what you can see is that there are a number of different types of support and resistance levels shown here. Everything from a previous low to the middle of a congestion zone, previous highs, previous lows. And then the one that I want you to really pay a lot of attention to is this equal move support. And that takes place when you have a sharp move in a security and then a correction and a continuation move. Now, the important thing to keep in mind when you're looking at these continuations is that when you have a move that, let's say we have a $2 drop in the EUI, and I'll just draw it up here. Let's say it looks about like this, and we have a congestion form. If this forms a continuation move, you would be looking for about another 2-point move here into what would serve as a really strong support level. So if we're looking at this as a market timing move and we're looking at this as a breakdown strategy, then we would want to place our targets at about that 2-point level. Now, let's go and look at pace or momentum, and we'll come back to this concept of the equal move here. I want to show you how these really are going to start to come together and work together to help you with this market timing. Support and resistance levels are a really core basic concept, but in and of themselves, they're not really going to help you out much at all because there's a number of cases where these so-called support or resistance levels will just break very, very clearly, or if they show a reaction, they might come into those levels, fall into a trading range instead of giving you a reversal. And if you're a reversal type of trader, you're looking at these support and resistance zones for entry strategies. Well, one of the main things that affects how a support or resistance level holds and whether it holds at all is going to be the momentum or the pace as the security comes into these support or resistance levels. Now, pace, which can also be called momentum, is a measure of the amount of time it takes for a security to establish a movement in price as compared to earlier price moves of the same amount. So, let's say a previous move of 2 points takes about 2 hours to form. And now it's already moved 2 points the opposite direction in a matter of 30 minutes. Well, it's moved the same amount of time, or the same amount of price rather, but it's done so in a quarter of the amount of time. So the momentum has shifted where we are seeing accelerated momentum, or if that 2-point move over 2 hours is pretty comparable to previous 2-point moves, then we would say that the 2-point move in 30 minutes is a substantially stronger than average price move in that security. Here's a template that I've used for a number of years, and I continue to use it in most of my presentations just because it has remained so valid over time. And in fact, you'll actually see securities that will literally follow this exact template from start to finish. And what you see here is how momentum or pace changes or shifts over time. If you have a sharper than average upside move, then the chances are higher that when the security corrects, it's going to have a more gradual pullback or more gradual correction. Now, when I'm looking at, what is an average price move? How do I know if something is stronger than average or weaker than average? A lot of traders will think, well, can I use the degree or the angle of a move? And you can't, because if you squish up a chart, it's going to completely change the angle of whatever that correction was than if I expand a chart and take more time or take a larger degree of space to show the amount of time. So you're going to be shifting those angles just depending upon how your chart is created and what your layout for your charting platform is. So you can't use degrees, but you can use basically what were the previous moves in the security where you had a V type of formation. And this V is usually what I will use to judge an average paced move in a security. So I will go back in a security and just look for previous V moves. And I will consider that to be about an average to slightly above average paced move. And I will then use that to compare the moves that follow to it. Now, when you have a shift that the momentum becomes weaker than a previous upside move, such as D compared to B, dog compared to boy, we have a change in momentum where we have this slowdown in the upside momentum, and a reversal becomes a much higher probability strategy. So for timing the market, you would look for this shift in momentum or slowdown in momentum as a reversal strategy. And there's a number of ways that this can form. This can form whereby you see it start to hug a moving average, such as a 20-period moving average is a very popular one that you will see this action form at. Or you can even see shift in momentum where we had, say, this sharp upside move, and we continue to see these large upside spikes. But if we look at the channel, you will see that the momentum of that overall channel is now substantially more gradual than the beginning of that channel. So you're seeing that shift in momentum in the overall trend channel, even if you don't see it in the individual waves within that channel. This is an example down here on the bottom where we look at this. You can see that the overall waves back and forth are what we would consider to be average momentum moves. But as a whole, we have a sideways trading channel or trading range. So compared to this uptrend over here, we actually have a shift in momentum where we're now looking at a sideways trading range compared to this previous upside move, and we have a shift in momentum now with some rounding off at highs. And that is going to typically lead to stronger downside follow-through. Within the trading range itself, from let's say E to I here, ideally to give you a great idea of what direction is a trading range going to break, look for a shift in momentum within that trading range itself. So even if a trading range is at the highs, let's say it's at new 52-week highs, for example, that does not mean that that trading range is going to break higher. We're typically taught as traders, especially beginning traders, that if you have a base or a congestion zone at the highs, that you look for it as a continuation setup. You look for a breakout higher. The problem is that you might get a breakout higher, but it might fail on you because within that range itself, you have a shift in momentum where it breaks the previous high, but the momentum into that new high was substantially more gradual than the previous moves to the upside. So it basically serves as a trap pattern. If you have that momentum shift within that trading range, though, and you use that channel to time a strategy, you're going to have a substantially higher return rate and lower failure rate when taking that in conjunction with a larger pattern or larger strategy than you would just using that larger strategy alone.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.